A dozen central banks are meeting this week and next week to discuss their rate hikes, and the going joke is 75 is the new 25. The biggest of them, of course, is the U.S. Fed, and next week the Reserve Bank hikes its rates. So we definitely need to get a grip on what central banks are thinking, how global inflation is panning out, and for that we have perhaps the best mind in the industry. I have with me Paul Gruenwald, the Chief Economist at Standard & Poor's, the rating agency's S&P. Thank you very much, Paul, for joining us.
My pleasure.
Okay, so that's the first question. I mean, what should we be prepared for from the Fed? Can they surprise even more than 75?
I think 75 is the baseline, but you're right. The new 25 is 75. Central banks are behind the curve, especially in the advanced markets. U.S. inflation is still printing quite strong. We're way above the 2% target. So the Fed is barely at neutral. We think they've got more work to do, perhaps a terminal rate of greater than 4%. So 75% looks like a good bet for this week.
Okay. You know, I saw your PowerPoint where you have downgraded growth rate for most countries.
Right.
How worried are you about growth next year? Do you see a lot of large economies, US, Europe, China, slowing down considerably? Should we worry about 23 more than 22?
Numerically, yes, because the first part of this year was actually pretty strong, for example, in Europe. The next 2 or 3 quarters are going to be weak. For us, the question is, one, we're obviously slowing. Do we go into recession? And two, what's really driving the downturn? So one of the things we're arguing right now as we do our forecast round is that it's not the same for the big three. So the U.S. is sort of a kind of a classical recession, overheating, too much inflation, and unemployment's too low to be sustainable, so we raise rates to slow things down. Europe, not so much in the way of macro imbalances, but obviously a big geopolitical overhang for Russia. That could last for more than a couple of quarters, depending on how the geopolitics plays out. So that's not going to be a classical down and up recession. And then China's, in a way, a self-imposed health story because of the COVID lockdowns, etc. So that's really a political decision of the government when they want to, or if they want to.
So tough to call.
Right. Move to a different regime than non-zero or zero COVID. So yeah, tough to call.
Okay. How does India figure in this? The Reserve Bank meets next week. Do you think they will have to go lockstep with the Fed? You're expecting a lot of rate hikes?
Well, first of all, the growth story, right? India is one of the few growth stories. We've got 7.3 for the current fiscal, and that seems like a huge number given what's going on in the rest of the world. Yeah, in terms of central banks and emerging markets, not one-to-one, but when the Fed starts to raise rates, central banks pay attention to the differential, and they also pay attention to potential capital outflows. So everything else constant, if the Fed goes more aggressively, the RBI and other emerging market central banks will probably be leaning in that direction as well.
So how do you look at India's growth story next year? Like I said, this year, India is definitely, as you put it, a great growth story. But if you are bringing down growth forecasts for large economies, will next year be an issue for us?
It will slow in India, but we've got 7.3 this fiscal and about 6.5 for the following fiscal. So we're still in pretty good shape. One of India's strengths is that it's a relatively independent economy. It's got a large domestic market. It's not too linked to any of the big three. So as long as we've got good fundamentals, so the contact industries are coming back. Balance sheets are good year for agricultural. So looks like 6.5 is doable even in the following fiscal year. So pretty good trend for India and close to potential. That's close to our potential growth rate for the economy.
Okay, that's good to hear. What's your potential? It would be 7?
6.5 to 7. We usually put a range. We don't want to be overly precise about these.
Okay.
Right?
Okay, I know that your sovereign ratings are a different unit, but would there be any macros you would worry about? I mean, would we qualify for rating upgrades since we are a good growth story?
Yeah, I'm gonna park the rating off to the side.
Agree.
Growth story wise, if I had to bucket the emerging markets globally, we would put India or at or near the top. Certainly where we are globally right now with slowing growth almost everywhere. 7.3 in the current fiscal, 6.5 for the next one looks good.
Exactly. We also have twin deficits, which is what raters normally worry about. But is the growth good enough for us to pay our debt? again, I don't want to put you into trouble by asking you to rate the country, but isn't the growth good enough to paper over the deficits, or would you still worry about
Well,
deficits?
we would look at the whole picture, right? So, and it also matters what kind of liabilities we have. If we have short-term floating rate, vulnerabilities, then the yellow and red lights start blinking. If we've got longer-term obligations, if we have a good growth story, good foundation, good investment story, which is largely true for India, yes, the current account deficit's going to be probably 3-ish in the next fiscal, and yes, the fiscal deficit's going to rise. I think in the larger scheme of things, we're still in a good macro bucket if we put everything together.
You wouldn't worry about the currency having to depreciate?
I wouldn't say never worry, but dollar rupee's about 80 right now. We will have some volatility. I think the market is still not clear exactly where the Fed's going and what the terminal rate's going to be and what the dynamics for inflation are. So for emerging markets, there's always going to be this kind of risk. And yeah, we're looking forward to the day, hopefully not too distant in the future, where we have a better path for global inflation and central bank rate rises.
Okay. Well, let me come to the rate rises. The Fed rate rises actually, or developed markets. There is a school of thought which believes that the Fed can go 4 and even beyond 4%. People who worry that there is a secular inflation problem. Inflation may come down from 8 to 4, but it may not come to 2, and therefore the Fed will have to persist. Do you see that happening? That Fed funds rate, is there a percentage of chance that it goes even higher?
That's still a risk scenario for us. So in our baseline, you're right. By the way, we're looking forward to the new dot plots that are coming out with the Fed meeting this week. But we have the Fed going to 4, maybe a bit more by the end of this year, early next year, and then staying there for a while. We think inflation is going to come down. The Fed will get inflation to 2, as will the ECB and other major central banks. But to your point, the question is how high do they need to go? If inflation is more stubborn than we think, and if more action is needed to tighten financial conditions, then the Fed will have to go higher. But right now, the baseline is the low 4s for the terminal Fed.
Okay, now at 4 or 4% plus for a longish time, are there any possibilities of financial instability? People too over leveraged and therefore likely to default. And if it is not 4 but 4.5. Is there a worrisome default scenario?
Well, the worrisome default scenario would be a much slower economy and much higher interest rates. We do have a unit in ratings that forecasts defaults. I don't have the exact number in my head, but the expected rise over the next year is moderate, especially compared to previous episodes, because balance sheets are stronger. But you're absolutely right. The interest rate sensitive sectors would be the ones hardest hit if we get a more aggressive Fed. If it's energy related and we're in a geopolitical stress environment, that's potentially another one. But yeah, those are the sorts of things we worry about. But again, the baseline is for only a modest rise in defaults, because many companies have taken advantage of the low rates and locked in rates for a longer time. What we call the maturity wall has been pushed out several years.